Hey everyone, Paul Ezell, the virtual investor, and just wanted to do a quick live here. Have not done this live yet on this account, but I want to go over some numbers, pertinent numbers here. If you're an investor, if you're a real estate investor, and you're thinking about what's going on in the market right now, and you're prepping for your year. We're now in February 13th. Now tomorrow's Valentine's Day. It's the first quarter is just flying by, and we really need to start ramping up. And if you want to know what's going on, you want to keep in touch with certain things and look at numbers and pre-plan your year out as much as you can. So on this channel, I've talked a lot about what I thought the market was going to be like here for 2023, how I thought things were going to shake out. And we started talking about it September, October, and into December, and even early in the year here. The rates overshot, right? Mortgage rates went from 3.25% in January of 2022 to 7.22% in late September of 2022. So you had more than doubling of the rates in under a 9-month period of time. It's never happened in under a year before, rates doubling in history of this country. So put that in perspective. That has not happened in our history. And so I think things overshot. It pulled a lot of people out. We lost 3 million home buyers when a rate shot up to 7.25%. Now rates are retracting as we thought they would. We anticipated rates would be retracting. We also anticipated inventory would continue to fall, but it's fallen. Honestly, it's fallen more than I thought it was gonna. It has continued to fall. Let's talk about that though. Why did it fall? So it's falling because most people that have bought over the years, however long you've lived in your home, whether it's just a year, 2, 3, you've got cheap money. You've got a very low interest rate into the twos. A lot of people in the high twos, 2.75, 3% to 4% mortgages. And when you're seeing mortgage rates fives, lower sixes right now, say around 6 or upper fives, that's not attractive to trade a 2.75 for a 5.75 or 6% mortgage, because that increases your payment a lot. When you're talking about the median price being around $418,000 on a house, that matters. That's a big price difference. So psychologically, buyers or sellers are not incentivized to sell. People are not incentivized to sell unless they have to for jobs, have to move. Or, if you're virtual, you could be anywhere, but maybe people do want to move. Maybe people felt like they got priced out. They wanted to move to Arizona, to Florida, to Tennessee, wherever, the Carolinas, somewhere south where it's warmer, so they can enjoy more outside and still work virtually for whatever company they're working for. So you had people that were priced out. Now the rates have dropped. Now they can maybe afford the property again. So what I anticipate here, starting in March, going into April, May, June, maybe even in July a little bit, and then fading off later in July, and really August, September, things will fade just like they normally do in a market, right? As people prepare and get ready for school, their kids are in school. People like to move by the summertime. Easiest time. People vacation during the summer. People move during the summertime, late spring and the summer for the school year if you have kids. So with that being said, I think we're going to have a huge burst here of buyers and activity. And we have record low inventory of 443,416 houses. Nowhere near healthy, like 1/3, 1/4 of the healthy market. Healthy real estate market's really at least a million, but usually 1.1 to 1.2 million homes available. And then you have a healthy market. People have choices. They don't get in bidding wars. So with the inventory being so low, you're going to have bidding wars again. You're going to have less price reductions. They are already dropping. That's down to 32.2% of properties having price reductions, which is really dropping down low compared to where it was in the fall when rates shot up. So you're really setting up for a strong, robust 2023 spring market, not 2022. That was a frenzy. 2022 was a frenzied market. 2021 was frenzied, but 2022 was something like we've never seen. And I don't know if we'll ever see that again. Probably won't. We had a combination, perfect storm of super low rates, maybe lowest rates we've ever had historically, and people being pent up from the whole lockdowns, right? From people being locked down from the pandemic. So people had pandemic, they were just done with it, right? People wanted to get out and do stuff. And moving was one of those things. So we don't have that right now, right? But we do have people who want to move that felt like they missed the boat last time. And now with rates dropping back down into their affordability range again, they don't want to miss the boat again. So they're not going to miss the boat again. So they're going to go and they're going to bid on houses. They're going to overbid and overpay and push the limits a little bit. And it's going to push prices up again. And prices are already moving back up. And we are at $418,200 for your average median home cost right now in the US. So that I anticipate getting maybe 4.25, could get a little bit higher than that, but somewhere in that range, 420, 425 range, I could see it getting into here during the peak and then pulling back again later in the year. I do believe rates will continue to drop, hopefully for owner occupants, maybe in the fours. They'd be ecstatic if that happened, or at least lower fives. For investors, I believe we'll get into fives again. And I'm really looking for that opportunity because I've got properties I want to refinance, rentals that I've put into service here this past summer, fall, and into the winter here, that I want to be able to refinance these properties, keep them as cash flow rentals, long-term properties. So we're going to have opportunities here as investors too. So what is your mindset as an investor? Are you somebody who's looking to buy and hold and add to your portfolio like I am doing? Are you just a wholesaler? Or are you a fix and flipper? Are you somebody who does owner financing? Whatever you're looking to do, you've got to look at the market, see what it gives you, and take advantage of it. So take advantage of it right now. If you got something that you want to be able to list for the spring, if you're working on a fix and flip, get that done so it's ready on the market March, April, May, June, during that time period. So you can take advantage of the price bumps here. And you're gonna do pretty well on these properties. Take advantage of it. We are adding inventory at record levels here. I've never added this much inventory this time of year as I am this year, which is great. Our acquisition managers are kicking butt. I'm adding some off-market properties here. I'm getting things from television, advertising in Southwest Florida. So all good. Trying to take advantage of this market, trying to take advantage of get rentals, because I don't know how long it's going to last, because I see 2023 is good for real estate. I see a shift coming for 2024, late 2023, really, 2024, 2025, a couple potentially rougher years, not awful years, but rougher. Like, you're not going to have this price appreciation. You're going to potentially have price depreciation, depending on what market you're in, because every market's different, obviously. And we're going to talk a little bit about jobs and how the jobs are affecting different markets and why some markets are going up and some markets are going down. We'll talk on that in a second. But first, what is your goal? If your goal is to do some fix and flips or do wholesales galore, we're doing more and more wholesales. I prefer to do wholesales. And I'm going to do a certain amount of targeted fix and flips in markets that I anticipate being very robust in this market here. So I would target those, and don't go gangbusters on fix and flips, because if this thing turns, if a black swan event happens, like a war, the war accelerates, becomes a world war, it's going to affect everything. It's going to affect the real estate market. It's going to affect jobs. It's going to affect everything across the globe. So know that you can't plan for that, but just keep that in the back of your head that could happen, and protect yourself as much as you can. Don't go hog wild doing fix and flips and have so much money out that you don't have cash when you may need cash. Now is still a great time for you to be hoarding as much cash as you can as well, and picking up great properties and buying at a deeper discount. I want to emphasize continuing to buy at a deeper and deeper discount. You need to buy at a deep discount. If you're not buying at a deep discount, you may pay for it. I see Ernesto jumped in here. How you doing, Ernesto? Feel free to add anything in the comments and give me what your thoughts are. And if you have any questions, put them in here. But what I'm seeing in this market is opportunity, but a short burst opportunity. See, maybe a little micro burst of 3-4 months where you're going to get some great prices on your fix and flips. Again, if you want to do the buy and hold, you're going to get price appreciation on a buy and hold, refinance that, pull that cash back out. So then do other deals with it, and hopefully you got a nice cash flow rental that's long-term for you. Remember, on rentals, do at least a 3 to 5 year term of planning on holding that property. Do more than that if you look, your mindset should always be to do longer than that, but 3 to 5 is the minimum, because most of the investor mortgages have a 3-year prepayment penalty anyway. They step down. Each year drops more and more and more. Generally, when I do my rentals, I do 3 to 5 year, and then certain ones I'm holding 10 to 20. There's ones I want to hold longer term. If I did a big full scale fix up on this thing that I know is going to last me 10, 20 years, I'm going to hold that longer as long as I can. Because my maintenance is going to be deferred. It's going to be lower maintenance in the first 5 years. The deferred maintenance will come in after the fact. For something you just did minor fix up and you're hoping this particular market is going to increase over the next few years because you see population growth going that way, you can play that. It's still, as long as it's cash flowing, you're going to be safe. Rentals are still going to be in demand. Rentals prices are still going up, but I want to make you aware for the fact that rental prices are still going up, but it's going to come back down here in the spring, summer, because as rates drop, as people can now buy, renters are falling off. There's going to be less demand for those rentals, less competition. So the prices may drop a little bit in different markets. Keep that in mind. It's normal. It's natural. Happens every cycle. But long-term, you'll be good. As long as you're cash flowing and you have a fixed 30-year rate mortgage, you're going to be in good shape. Okay. So more on the numbers here. So the average listing price right now is $389,900. That's going to be going up here into the spring. Obviously, people are going to be listing with this record low inventory, and the prices they're going to push up as much as they can here. Unemployment, the jobs report came out was a week ago, and it looks sensational, but it's really a lot of fluff that politicians put out there because it's all entry level jobs. You're talking about starting jobs, your $15 an hour jobs. Nothing big, people that are renters, not a whole lot of buyers, home buyers out there. So nothing that's going to affect in a real positive way the real estate market because the jobs are not good, long paying jobs. And the jobs that are being bled right now that people are losing are high paying ones. So the tech sector got destroyed. The NASDAQ got destroyed this whole past year. And it's going to be a lagging indicator. And you'll see the effects of it start July, August, September, October, because a lot of these people are laid off, late in the year, last year or last summer. And remember, they're collecting unemployment for 6 months, sometimes a little bit longer, depending on where you live. And that's going to eventually run out. And then they're going to be hurting. And they're going to either turn into renters or they're going to have to sell their properties. Part of the reason I could see things in certain markets really shift upward again. But the markets that have been hit the hardest this past year are the tech markets. San Francisco, you got Oakland, you got Phoenix, Arizona, you have Austin, Texas, you have Denver, Colorado, and Raleigh, North Carolina, even though that's not going to be affected as much because it didn't go up as much pre-pandemic as it did in other places. So those tech markets will be hit. Remember, tech jobs are very high paying jobs. So people are paying, buying $400,000 to $10 million houses, depending on what level they are in the tech sector. So these are people that are buying houses and active. Those are the ones we got to know and understand what jobs affect us as real estate investors to bring our buyers in, our buyer pool, if we're fixing and flipping to an end buyer. Now, if you're wholesaling into an investor, again, you got to be careful too, because a lot of investors fell off the board in 2022 when the rates went flying up and demand went down. So keep that in mind. There's definitely some things that are going to affect us, and in a positive and negative way here in 2023. But 2024, 2025 could be a little bit rougher. So I'm reading Ernesto's response here. I've been waiting for a few years for the market to soften. Trust me, so have I, for like 7-8 years. So he could buy his personal residence. I'm tired of the lack of affordability. Totally get it, Ernesto. And depending on where you're looking to go, I mean, you're still running into that issue right now, right? And we got such low inventory, it affects somebody like you more than it's affecting a real estate investor, right? But it does affect us too, because we can't get deals at as good of a discount if there's just not much inventory. So I push into different markets, tertiary markets here. But if you're looking for your home residence, you want to get it when the rates drop down, obviously. I got fortunate when I moved here in 2021, I got 3% rate on my home, and I never plan on selling it because it's the cheapest money I have. I'll just turn this into a rental and if I can pull a home equity line of credit if I need to borrow to put money down on the next place, or just use some Bitcoin and put some money down on the next place. But anyway, getting back to Ernesto's comment here about he's sick of lack of affordability. And this is most people, they have buyer's fatigue out there. They're sick of bidding wars. They're sick of having to rush out and see a house and make an offer and give up everything to the seller, which I get. I totally get that. And it's This has been driven by the Federal Reserve by pushing rates down artificially, pumping money into the system, and it affects everyday people, unfortunately, like Ernesto here. And they're not going to change anytime soon, unfortunately. They're going to continue to do what they do. They're reducing, they're tapering off their increasing of the rates, which is good because they were really damaging the markets and creating demand destruction. But if they would have kept on that, people like Ernesto might be able to find deals in real estate sooner, but they're not because they're helping their buddies out, unfortunately, in Wall Street, and they're going to continue to try to help them make more money and make it harder for your average Joe to be able to buy a house. But there will be a time, 2020, end of 2023, really 2024, 2025, 2026, great opportunities I think are going to be out there. I think you're going to find things discounted 10, 15, 20% in different markets, especially Southern California, potentially Arizona, definitely Las Vegas, potentially Denver, and some of those markets will continue to go down. Florida, eventually different markets in there will be hit. Everything's going to be hit at some point or another if unemployment continues to increase for higher earners, for people that make decent money, your home buyers out there. And for renters, if let's put it this way, if interest rates go up, you're pushing more people into rentals, right? So just watch the correlation. It's basic macroeconomic thing. As interest rates go up, home affordability goes down. Then you're forced into a rental. Lots of people are forced into a rental, pushes up rental prices. Yeah, it's great if you're a landlord. However, how can people afford to pay for that rental, pay for your grocery bill? And I can tell you, every single time I go to the grocery store, I don't spend less than $300 unless I'm just grabbing a few things. It's just so ridiculous how much groceries cost, food cost. I got a family of 4, so it's a couple grand at least a month I'm spending in just food, and that's not going out food. That's food for the house. More money and going out too, which is ridiculously priced too. But just want to keep you guys in check here that we are going into a market in the spring where there could be a buyer's frenzy, and Ernesto this spring, depending on where you want to buy, may not be the time to buy if this happens in your particular market that you're looking to buy. And just put in the box there if you want to make a comment as to where you're looking to buy, let me know. And I could try to point you in the right direction and give you a hand there. But home affordability is going to be tough again here in the spring and even into the early summer. And then we'll see what it goes next year. And we have to reassess it. As an investor, you can look at it and reassess your business. I used to do it quarterly and then do a hard look at end of quarter 2. You're in San Antonio, red hot market, great market, San Antonio, Texas. One of our students is down there in San Antonio. His name is Trey. He's good. He's a great rehabber as well. There's going to be opportunities there in San Antonio coming up. There's a couple I see on auction. So Ernesto, reach out to me, put your info in the comments here, reach out to me, let me know. I'd love to be able to find an opportunity for you to get something under market value that's an off-market property on auction that you can get at a discount and have some equity in there. And maybe, do a little fix up and force the price up, get some forced appreciation out of it. First place I bought my first home in 1999 that I bought when I lived up in Pennsylvania was an estate sale, which is very similar to buying on online auctions. You're getting something that needs a lot of work, and this thing did. This thing had a huge 3x3 hole eaten by termites in the kitchen by the refrigerator. It had 12 joists eaten up by termites that I had to sister 12 joists. I had to replace 20 foot of main beam. I did that in a weekend with my brother-in-law. Luckily, long weekend, Friday, Saturday, Sunday, but we knocked it all out, got that fixed. Over the years, I really fixed that property up. And I had something that had instant equity, which was able to propel me in my real estate investing business, because what happened was I was able to refinance that property, pull line of credit, and buy other properties to fix and flip, to buy and hold, and just continue to compound over the years and do. So buying on online auctions, there are definitely opportunities there. In San Antonio, Ernesto, that's a great market. It's going to be a good market for a very, very long time. A lot of great jobs down there. Texas is just great. I'm big into Texas. I think we have 8 properties right now in Texas that are active between rentals, fix and flips, and properties that we're picking up right now. Definitely some that I'm looking at on auction in San Antonio markets. There's some opportunities. There's some, maybe neighborhoods you don't want to have or be in, but could be a good rental in there. But the market's different. Market's shifting. It's getting interesting. And I want you guys all to be prepared for what's coming. And just, we've been seeing this and we're preparing for it. We got a lot of properties to put out there in a spring market, hopefully take advantage of it, get some cash, put it aside, and reassess. So as I was talking about before, I knew I used to do quarterly looks and then a hard look at the 6 month mark. Really, July is where I'd really look at the end of June. First week of July, July 4th, everybody's shut down, that kind of week. A lot of people on vacation. I look at my numbers, see what market that we've done well in, what markets we have not done well in, and which price points working, where prices are going in different markets, and we reassess and we'll attack certain markets. We'll get away from other markets. Like right now, we're avoiding New York like the plague. A lot of the Northeast we're avoiding like the plague. But Midwest, we still love the states we love, Indiana and Ohio. We still love Pennsylvania because you can find good price properties there as well. The Carolinas, Georgia, Florida, Texas, Alabama, Tennessee. We've even done a bit in New Mexico for the last couple of years. So that market's heated up a little bit, and I've gotten priced out of that a bit. But we're continuing heavy in Texas, heavy in Tennessee, heavy in Florida, and heavy in the Carolinas and Indiana and Ohio. And they've been bread and butter for us, Indiana and Ohio, since I've been buying. And in 2009 was the first year I bought outside of my market when I lived in Pennsylvania, when I was buying in Ohio and Indiana and Virginia and the Carolinas. So it's been a while since I've been doing that, and it's worked out pretty well. But those are slow, steady, linear markets where the prices slowly, steadily increase. And, you got your markets that are cyclical markets like California, Florida, that go up and down. And, Las Vegas is heavily driven by the economy. If the economy's going great, Las Vegas is booming. If the economy tanks, like the financial crisis 2008, Vegas gets destroyed. And then there's buying opportunities out the wazoo. So last point before I finish here, markets that you see getting hammered, you don't necessarily have to stay away from them. You just need to buy at deep, deep discounts and hope you're buying somewhere near the bottom of the market, or hopefully in FSNE, or just getting something with a lot of equity where you have great opportunity, where eventually that market does bounce back down the road. Then you've got an opportunity to make some serious money. The mistake I have, and one thing I still kick for myself for, is 2009, not buying a ton. I was really looking in the Denver, Colorado market. And there were things I could have picked up 30, 40, 50, 60, 70, 80 to 120,000. All those properties worth $250,000, 300, 400, 500 plus thousand right now that I looked at. I kick myself for not buying. That was a great opportunity to buy. That was a hammered market. That was before a lot of people moved from California to Colorado as another tech area. So look for those areas that are growing and have that opportunity that get hammered in the next cycle. And that's where you want to buy at least a few so you can have some and get some future growth if you keep them as a rental and then sell them later on. All right, everybody. I hope you guys enjoyed this, and hopefully you guys got a bit out of this. And I will catch you. And I'm going to try to do more of these live streams, and I'll try to do them at more rational daytime hours. Appreciate you being a part of here, Ernesto, and giving me some questions and some feedback here. Take care, guys. We'll catch you in the next one.